The federal government just moved to close the last door on non-citizen access to FHA loans. And if you serve this country, you need to understand exactly what that means for your position in the housing market right now, because most veterans are sitting on a benefit that's quietly getting stronger while they're not paying attention. If this is your first time here, do me a favor, hit the like button, subscribe, and ring the notification bell. I drop real estate content built for veterans and first responders. No hype, no BS, no theory, execution only, and I don't sell a program. My name is Bud Evans. I'm a 35-year United States Air Force veteran, 13 years law enforcement veteran, former mayor of Cinnaminson, New Jersey, active real estate investor in single family and small multifamily. I founded a low-cost, investor-focused property management company, and I mentor veterans and first responders on building real estate portfolios on a standard income. Now let's talk about what's actually happening and why it matters to you. And I promise you, at the end of this video, you're going to have a checklist to follow to make sure you don't make these mistakes. So here's the baseline reality most veterans walk in with. FHA is for civilians, VA is for veterans. The two programs run in separate lanes. What happens inside FHA program has nothing to do with your home buying strategy. That's the belief. And that belief is exactly why veterans keep leaving money on the table. For years, the FHA loan program ran a category called non-permanent residents. That category allowed individuals who did not hold U.S. citizenship or a green card to access FHA-insured mortgages, provided they had a valid Social Security number and work authorization. The Biden administration expanded that eligibility in January of 2021 to include DACA recipients specifically. That meant the buyer pool competing for entry-level single-family properties, which included veterans using VA loans, U.S. citizens using FHA, and non-permanent residents also using FHA. All three categories were often targeting the same price range, the same neighborhoods, the same 2 to 4 unit properties that you would want for a house hack. Now, here's the real world consequence that nobody talks about at real estate seminars. I've sat across the table from veterans who chose FHA over the VA benefit because someone told them it was easier or faster. These are people who qualified for VA financing, people who could have purchased a property with zero down and zero monthly mortgage insurance. Instead, they were paying a 3.5% down payment, an upfront mortgage insurance premium, and a monthly mortgage insurance premium that does not go away on most FHA loans. Over 10 years on a $350,000 purchase, that mortgage insurance alone is going to cost roughly $30,000 to $40,000. It depends on the loan terms, but that's money that you wrote checks for that you didn't have to spend. This isn't complicated. Veterans who do not know their benefit is superior to FHA end up paying that FHA price for a decade or more, and they do it because nobody told them or walked them through the actual comparison. This is what happened. On March 26, 2025, HUD issued a mortgage letter 2025-09. That letter eliminated the non-permanent residency category from FHA Title I and Title II programs entirely. Effective May 25, 2025, only U.S. citizens and lawful permanent residents, meaning green card holders, can access FHA-insured financing. DACA recipients, pending asylum application, H-1B visa holders, F-1 visa holders, all of them got locked out of the FHA, and that rule is in effect already today. Then last week, a new congressional bill was introduced that proposes to go even further. A bill, if passed, would restrict FHA, Fannie Mae, and Freddie Mac access to U.S. citizens only. Green card holders are removed from the eligible pool entry. That bill has not passed yet, but it is on the table and it has support. What does that mean for you as a veteran right now? It means the competitive environment for entry-level housing just shifted, and it's continuing to shift in a direction that's going to benefit anyone holding a VA benefit who knows how to use it. If you're a veteran and you want to connect with other veterans doing exactly what we're talking about right here in real time, do me a favor, check out the War Room with David Perret. It's one of the strongest veteran real estate communities operating today. I've been a member since December of 2019. If you want to work directly with me for a one-off call, go to budevans.com and book that call. I don't sell a program. So let's get into the execution. Here's how the VA loan and the FHA loan actually stack up in 25 and 26 side by side. Down payment. FHA requires a minimum of 3.5% down if your credit score is 580 or above. VA requires zero on a $350,000 purchase. That is $12,250 you do not have to bring to the table as a vet. Mortgage insurance. This is one that costs vets the most over time. FHA has two layers. There's an upfront mortgage insurance premium of 1.75% of the loan amount, And then there's an annual premium paid monthly that continues for the life of the loan in most cases. The VA has a one-time funding fee in place of mortgage insurance, and you can finance that. Once the fee is paid, you never pay mortgage insurance again. Veterans with a service-connected disability rating, Purple Heart recipients, and eligible surviving are exempt from the funding fee entirely. If you have a disability rating and you're buying a home with zero down and zero funding fee, that's not a workaround. That's an earned benefit. It's not an entitlement. I hate it when they say that. Interest rates. VA loans have carried lower average interest rates than FHA loans consistently. According to 2025 data from Optimal Blue, VA loans averaged about 1/4 to 1/2 point lower than FHA. That, spread over 30 years on a $350,000 loan, it's a pretty substantial number. Go ahead and run that yourself. Let's talk about loan limits. As of 2020, veterans with full VA entitlement had no loan limit. FHA caps out at $541,000 and change. In low-cost markets, $1.25 million in high-cost markets for 2026. If you're in an expensive market, your VA benefit has no ceiling, FHA does. Multi-unit eligibility, both FHA and VA loans can be used to purchase properties up to 4 units, provided you occupy 1 unit as your primary residence. That's a house hack. You buy a duplex, triplex, or quad, you live in 1 unit, and the rental income from the others offsets your mortgage. A VA at zero down on a 4-unit property with rental income covering part of all of your payments is one of the most powerful entry points in real estate investing available to anyone in this country. Most veterans still don't know they can do it. Now let's walk through a real-world example so this is not vague for you. Let's say a veteran's looking at a duplex priced at $320,000. They've been told by a loan officer that FHA is the way to go because the process is simpler and the inspections are easier, which is crap. He puts down 3.5%, which is $11,200, pays the upfront MIP of 1.75, rolled it into his loan, carries a monthly MIP payment for the life of the loan. The rent covers the second unit, which is about $1,200 per month towards his mortgage. Net cash out of pocket will get that deal with the FHA. It's over about $11,000 in closing, and he carries insurance costs for years. That same veteran using a VA benefit put zero down. You may be looking at a funding fee, which is a first-time VA buyer in 2025 is 2.15% of the loan amount, which you can roll into the loan. You have no monthly mortgage insurance. Your rate is slightly lower. Your net payment is lower. Your rental income from the second unit still covers $1,200. And if you have a disability rating, the funding fee is waived. You close that deal with significantly less cash, if any, out of pocket and lower long-term carrying costs. This is not theoretical. This is a decision that represents itself every day across the country for veterans who don't know to ask these questions. Now, here's the common mistake that I see most often. Veterans assume that because FHA was their neighbor's path to homeownership, it should also be theirs. The neighbor didn't serve. The neighbor doesn't have access to VA financing. The neighbor made the right call with the tools available to them. You have a different tool, a better tool. Use the right tool for the right job. Don't hit a screw with a hammer. The second common mistake here is not getting your certificate of eligibility before making offers. Your COE is the foundational document that confirms your VA benefit is active and available. Without it in hand, you're not ready to make an offer. You can get it through the VA eBenefits website or through the VA eBenefits portal, through your lender, or directly through the VA. Third mistake here is choosing a lender who handles 1 or 2 VA loans a year. Guys, VA loan underwriting has specific requirements. The appraisal process has minimum property requirements that differ from FHA. You want a lender with volume experience in VA loans, not a generalist who treats your VA loan like a slow FHA loan with a bunch of paperwork differences. They are not the same. The fourth mistake is not verifying your funding fee exemption status if you carry a service-connected disability. Your lender should ask. If they don't, ask them. This is a fee waiver that can run into the thousands of dollars. Do not assume that that box was checked. The fifth mistake here is misreading seller resistance to VA offers. Some sellers and listing agents will tell you that VA loans are harder to close because of an appraisal requirements. That's a negotiating position, not a fact. VA loans close. Work with a real estate agent who has experience with VA transactions and knows exactly how to position your offer right. Seller concessions on VA loans are negotiable up to 4% of the home's value. That's a real advantage in the right negotiation. So, as always, like I promised, here's your checklist. Work through this in order before you make a move on your next property. 1, confirm your certificate of eligibility is current. Get it through eBenefits, your lender, or directly from the VA. 2, if you have a service-connected disability rating of any percentage, verify your VA funding fee exemption status before you close. Don't assume that your lender checked that box. 3rd, run a side-by-side cost comparison of VA versus FHA for your specific purchase price. Include the total mortgage insurance cost over 10 years in the FHA column. Do not compare monthly payments in isolation. Next, if you're looking at a duplex, triplex, or quad, confirm the property meets VA eligibility requirements and run the house hack numbers. What does the rent from the other units do to your effective monthly payment? 5th, before you make an offer on any property with deferred maintenance or visible issues, understand the VA minimum property requirements. The VA appraisal is protecting you, not slowing you down. Target the right inventory. Work with a lender who closes VA loans regularly. Do not work with a lender who only does them occasionally. 7, work with a real estate agent who has closed VA transactions and knows how to structure your offer to make it a more competitive situation. If you are comparing your VA offer against other offers in a competitive market, know your seller concession ceiling and use it strategically. Do not let anyone talk you out of your VA benefit. Not a loan officer with an FHA quota, not a listing agent with a preference because it'll sell better, not a well-meaning family member. Your benefit is your benefit. Be a subject matter expert in it. It is earned and it is real. If this video helped you understand how your VA benefit actually works in today's market, do me a favor, hit that like button, subscribe, ring that notification bell, and share this with other veterans who can benefit. I'm Bud Evans. Thanks for watching. Aim high, execute fast. See you on the next one.